Ladies and gentlemen, thank you for taking the time to be with us today and welcome to this M&A Master Series webinar, which is our sixth webinar in this series. My name is Prasanjit Chakravarti and I'm a partner in Ketan's corporate and M&A practice group. I would like to extend a very warm welcome to this webinar to every one of you, whether you are in our audience in India or around the world. M&A Masters program is designed to provide sophisticated education and discussion on contemporary M&A issues to experienced corporate executives, in-house legal teams, investment banks, intermediaries, and other participating or interested members in M&A in India today. Our topic today is Private Equity M&A, a segment that continues to command attention amid India's dynamic economic and regulatory environment. On this slide is the agenda for today's webinar. If you do have questions, please submit them using the facility provided in the webinar portal. If we cannot cover all the questions during this webinar, we will respond offline by email after the webinar. Also, please note that a copy of this presentation on your screen, along with the summary notes and the recording of this webinar, will be sent to you after the webinar as a matter of course. Now, just introducing this topic today, private equity transactions are really straightforward. If M&A were a game of chess, PE deals would be the grandmaster's board. Complex structuring, intense negotiations, and the need for razor-sharp alignment between the founders, promoters, and the investors make each transaction both a legal puzzle and a strategic play. From valuation gaps to control rights, from exit strategies to compliance challenges, every stage of a private equity transaction presents a unique legal and commercial consideration driven transaction. Over the next hour or so, we will delve into some of the most relevant and timely themes shaping the M&A market in India, including like trends in minority versus control transactions, shifts in bargaining powers between the founders and the investors, innovative structuring, for example, earnouts, deferred consideration, platform acquisitions, key diligence priorities, and evolving risk allocation practice, current exit trends, and regulatory bottlenecks. Our goal today would be to move beyond the theoretical aspects and offer practical insights grounded in real world deal experience, enabling you to better navigate the shifting contours of private equity deals in India. We're now ready to hear from our expert panel, and therefore, let me just spend a minute to introduce the panel. Everyone who has registered for this webinar should have already received via email a summary of the panelists' details and their credentials. Suffice to say that each of them brings a deep expertise and a wealth of experience and practical insight to the subject, and we are very fortunate to have such a distinguished panel with us today. Our panelists today are Ashutosh Sampath, Shishir Vaitadin, and Anshuman Mozumdar. With that, let's bring this panel and begin the discussion. The first question, if I in fact, guys, throw it wide open to all three of you, what are the most notable trends in private equity M&A in India over the last 12 to 18 months? Anshuman, Ashutosh, Shishir.
So I'll go first, and thanks for the introduction, Prasenjit. We have seen quite a few trends, and the few notable ones are there has been a significant increase in the number of control deals by private equity players in India, both through the traditional acquisition route as well as the platform strategies across various sectors, across various themes. So that's definitely one of the more popular trends, and we have moved away from the age-old, proven technique of basically having the promoter build out a business where the promoter continues as the controlling shareholder and private equity only takes minority positions. We are now seeing private equity actually building businesses and also turning it around in a couple of years' time. So that's definitely a major shift that we are seeing in how the big boys of the private equity market are approaching deals in India. Another key trend that we have noticed in the last couple of years is various successful exits by private equity players, both across public markets as well as using private sales. A large number of exits have happened through public markets, and this is largely attributable to how well our public markets have been doing. In fact, there was a week last year where we saw almost seven filings before the SEBI for offer documents. So, and we have had even large corporates even undertake IPOs. A lot of tech companies with many series of investors undertake IPOs. So there has been a successful exits. Another point which I will just mention, and I'll just pass it on to Ashutosh, is the use of WNI, which is warranty and indemnity insurance, as as a tool to stitch absolute no recourse deals has facilitated a lot of private equity exits, because traditionally we have always struggled and negotiated when representing a private equity seller on what warranties to give, what limited indemnities to give. I think now the WNI tool, and given the reducing premia on WNI products, has enabled private equity to negotiate complete no recourse deals, which is a great outcome for the private equity which is exiting, and also solves for the risk allocation for the buyer. So I think these are the key trends which I would focus on, and I'll leave it open to Ashutosh and Shishir to add on.
Yeah, and if I may just add one more trend that we are seeing, just adding to the point of control that Anshuman is making. So what we are seeing, P's employ is what we call a platform strategy. So not only do they acquire and take control of one single asset, what they do is that they use that single asset to then make bolt-on acquisitions around that asset, build an entire platform, and then exit from it. This allows them, especially in fragmented sectors, to have the ability to consolidate, take market leadership, and build value. And I think that is one aspect that has resulted in the market maturing far sooner than we thought it would, because you have a situation where Ps are no longer deploying capital and building value. They're also building value through value creation, through consolidation, and then selling a large asset that they've built themselves, controlled, and built from a management perspective. Shashir?
I agree with what Anshuman and Ashutosh have said. On control, I think what's also driving the trend is that families, in many cases, have very limited relevance to operations now. In fact, in many instances, the second generations are not even involved in the operations. And there is now in India a much deeper pool of talent which is willing to work for private equity owned organizations because of access to ESOPs and other incentives, and generally not having to work with family controlled businesses. Outside of control, I'd say the other notable trends in private equity are just scale and focus on distressed assets. I was reading in the last McKinsey Global Private Markets report that over the last 5 years, the top 100 GPs have made approximately three times more acquisitions of competing GPs than they did in the previous 5 years. And what that does is large funds, large private equity funds with the ability to move quickly with large checks have a significant deal advantage. And we've seen that play out time and again in the last 3 to 4 years with some of our clients. So that scale is certainly a new trend in Indian private equity. And the other, like I mentioned, is the attention to distressed assets. What we're finding is either because of economic cycles or because of stress within the conglomerate, it often happens that assets which have good operational features are available for cheaper multiples. And we just find that the deal savvy of private equity investors is considerably higher than conglomerates or corporations unless they've been acquisitive historically, and that gives them a considerable advantage. Both these things have now converged in the last 2 years, and we're seeing a lot of assets in distressed private equity transactions.
Thank you. Thank you, Shishir, Ashutosh, Anshuman for setting the stage and context wonderfully. I think moving on, maybe Ashutosh, the old age question of control versus minority. Are PE players happy with a seat at the table, or are they increasingly gunning for the top of the table? But what's your take on that here? Ashutosh and mute,
Prasad,
yeah.
yeah, sorry. Prasad, historically, India has been a market where PEs have only invested a minority position, and that continued for a number of years. Many reasons for that. One, of course, that promoters themselves were not ready to cede control, and the other was that PEs were not also fully familiar with the Indian market, the regulatory challenges that come with investing in India, the cultural complexities. But that's changing quite quickly, and we see a great shift towards PEs preferring control over minority. There are some sectors, of course, where minority is still the norm. So let's say in technology, where perhaps a single PE player may not take a full majority or controlling position, especially because that entity may have a lot of growth requirements, capital requirements. But in other capital intensive sectors like manufacturing, industrials, healthcare, more often than not, we see PEs taking controlling positions, if not completely buying out the assets themselves. Again, many reasons for that. The first being that control, of course, gives the PE investor greater decision making ability, both from an operational perspective, strategizing for growth and for exit. The second is, like I said previously, Ps weren't fully comfortable with the Indian market, familiar with the Indian market. That has changed significantly now. Many of the PE players in India have seen multiple cycles of investment. They've seen exits come through. Many of them have set up very large teams in India now, and with feet on ground, I believe they believe that they can take greater control, have operational decisions taken, and build up management themselves. So I think the fact that Ps are more familiar with the Indian market has really helped move the direction of the deals from minority to control. The third is the slow but continual shift that we've had in the regulatory landscape, where liberalization has happened. Most sectors in India now are open for investments 100%. And even where approvals are required, the process are a lot more streamlined than they were previously. That allows greater ability for the PEs to come in and take control. And finally, Shishir also sort of alluded to this, that there is a change in the promoter mindset. Previously, promoters were not willing to cede control, but we see that changing quite quickly now, be it for succession reasons, like Shishir mentioned, or there are times when the size of the asset is just so large that the only buyer that the promoter can possibly find PEs with the checks that they can write. So I think that's the other one. And the third catalyst that I think that has helped in this entire change in mindset of the promoters is the enactment of the insolvency in the bankruptcy code. So although PEs are themselves not bidding for assets in IBC, what IBC has led to is that to the extent that the promoters see that there could be stress in the system, the fact that they could have a situation where they could default on payments, I think they're planning forward where an asset that becomes financially distressed, they are willing to sell control positions at that to be. So that really is the mindset shift that we're seeing, and we see control now being the main focus of peace as compared to minority positions. Over to you, Prasanjit.
Thank you, Ashutosh. That was very insightful and helpful to decode that aspect. Moving on, I think the next aspect, power dynamics is extremely fascinating, Shishir. When we talk about who has the edge, who has the upper hand. So, in terms of, bargaining power of P investors, co-founders, promoters, have you witnessed a shift in recent deals?
So, Prasan, I think there is a shift, but it's not private equity versus promoters. It's driven entirely by asset quality and sell side liquidity constraints. Owners of high quality assets, good brands, businesses with deep moats, I think historically also they've had a competitive advantage and therefore tremendous bargaining power. I think what I feel now is increasingly consolidation across sectors has meant that in every industry there are very few of these high quality assets left. So If the asset is a very high quality, I think the sellers obviously will have a much higher power of bargaining, whether that is private equity or Indian corporation owned is just a matter of what it is. What might happen oftentimes is private equity investors are more familiar with auction processes, more familiar with deal terms. They're generally a lot more deal savvy. They're more familiar with reps and warranty insurance and other tools that are used in M&A than first time company acquirer. So unless a company has historically been acquisitive and have dedicated M&A teams, what happens is companies, when they're competing with private equity investors, tend to double hat during M&A structuring and negotiations. So they find it, they struggle because they have a day job and doing M&A is not is not that day job. In that very, very narrow sense, some companies might find that they are at a disadvantage compared to private equity bidders, which is, of course, where a good set of advisors, like our own firm, and the right choice of other advisors makes a difference. But I'd say these tend to be the drivers of bargaining power, and not so much whether it's private equity or founders.
Right. That's interesting, Shishir. So I think moving on, I think maybe Anshuman, maybe you can take this. In terms of sectoral shifts, and where do you see the P folks, kind of looking with great interest? What sectors is catching eye? Where do you think the money is flowing in?
Sure, and I think consistent with what the trend has been in the past couple of years, we have seen the big sectors like real estate, which includes data centers, infrastructure, which includes roadways, transportation, energy, in particular renewable energy and various forms of new energy. So these sectors continue to attract more and more capital, both from foreign investors as well as domestic investors. And of course, certain additional sectors such as pharmaceuticals, healthcare, um, financial services, and various subsectors of financial services that continue to attract more and more capital. I think even in sectors such as financial services, because of government policies now, there is great amount of interest in the insurance sector. Recently, we have seen a lot of interest in the wealth management, investment advisory, professional services businesses. So these are the traditional avenues which continue to receive more and more private capital. Uh, it can also be attributable to, for example, in the real estate sector, to new exit avenues for REP investors such as REITs, which were not existent before the REITs regulation came into being. So other than this, there are also some sectors which have seen renewed interest. For example, there have been a fair number of deals in the revenue cycle management firms, which are also uh, shaping the product offerings through tech platforms. Tech and fintech continues to be one of the sectors attracting more and more interest. Consumer retail has also seen some decent amount of activity. I think we have seen slowdown in a few sectors such as tech or e-commerce, but largely the ones which I mentioned are the ones which are still sort of getting more and more private capital.
Right. So the next question actually was for Ashutosh. I think we just have lost him. So maybe I will go ahead and pick the next question and come back to Ashutosh. Uh, so in terms of structuring, maybe I can pick up that, in terms of acquisition versus platform, what is Anshuman, the structural preference, if you can throw some light.
So I think when we talk about buyout funds and control deals, so we continue to see both kind of structures in the traditional majority acquisition structures, as well as the platform strategy. So it depends on a couple of factors. One is the sector itself, uh, and talking about the specific target company, the kind of demand and supply gaps that the private equity is trying to solve through the platform strategy, and also what kind of interest the industry shows in the product offering that the private equity intends to create through the platform strategy. So, and we see platform strategies of two types. One is a simple aggregation of assets in the sector, which are cash generating assets. And we see this more often in the infrastructure sector, where, let's say, a private equity builds a platform to acquire various road assets, which are essentially cash generating. We also see the platform strategies where the intention is to develop internal synergies, solve for gaps in supply chain and R&D, and we see it quite often in the pharmaceutical sector. So there have been several large private equity players who have set up generic pharma and other types of pharma platforms. So we see this quite often. We also see the platform strategy being used even in the financial services space. So that's one of the reasons, or one of the, so basically the sector and the target is one of the contributing factors. The other factor is also the promoter or the founder who will basically run the platform. So at times, if the private equity is simpliciter acquiring 100% of a company and is piggybacking on a founder that it acquihires, then we will obviously see a platform strategy if the private equity wants to scale up through bolt-ons. But if the private equity is banking on the existing promoter who's resistant to do more M&A, then we would probably continue see the acquisition strategy without the company necessarily becoming a platform for future acquisitions. So even the promoter or the founder that the private equity is banking upon can be a contributing factor in these sort of situations.
Right. Excellent, Anshuman. So thank you for that. I think Shishir, if I may turn to you in terms of due diligence, which is much more than just a hygiene exercise. So what are the emerging trends in the diligence context?
So, Prasan, we find a lot more focus now on related party transactions, dependencies that the target has on the expanded promoter group, because some of them may be propping up revenue figures historically or suppressing expense line items historically. And when you find that the asset is taken away from that promoter ecosystem, suddenly you're saddled with costs that you had not modeled in, or you suddenly find revenue streams, or even on the balance sheet side, suddenly contingent liabilities, guarantees issued for promoter entities that have the acquired group. All these things emerge. So I certainly feel related party transactions is an area of considerable interest, especially to private equity owners. And the other is just because of the government agencies that have become extremely active in the last 10 years. I think there's a lot of attention in some sectors to ABAC, to the possibility of money laundering type investigations. So, if there have been investments in the target or shareholders in the target that could potentially be tainted in the future, just given how broad the enforcement actions have tended to be, and given how little judicial intervention happens, I think that's a very high area of concern. So if and this may not be relevant across sectors, but in some sectors there's a lot of focus during diligence to uncover any ABAC touch points.
Right. So yes, I think definitely these are areas Shishir P folks are digging in more, increasingly more. And
Yeah.
and I think as we go to another interesting aspect, maybe Anshuman, to you in terms of what's hot on the exit highway. So when it's time to cash out, where are the P folks really looking at in terms of IPO? Does it continue to be a hot favorite? Is it primary, secondary? Can you shed some light on that? You're mute.
Sorry, man. Continuing on the lines that I think I was mentioning for the first question. So we have been blessed with uh, a very buoyant public market, and I was saying, as I was saying, that the private public exits, exits of private equity through the public markets has been one of the largely accessible avenues for the private equity to basically structure its exits, uh, which is also the reason why we see a lot of dual tracks where the private equity is running a private sale process as well as planning a public an exit through an IPO route. Uh, if I have to answer your question on what is the preferred route, there is no one size fits all sort of an approach. It will largely depend on what type of company is involved, and what is the nature of the asset. So if it's a very popular appealing sector like a pharma sector, and it's a good asset, then you would often see a private sale run through a competitive bid process where we have now seen close to, $1 billion plus deals being stitched by private equity, by private sales run through competitive bid process. Um, but we have also seen those instances where maybe the appeal on the private sales side is not as great. And in those instances, we have resorted to the IPO route. We have also seen some instances, which is largely becoming popular now, of funds who are at the end of their fund life, even rolling over a bunch of portfolio assets onto another fund. And it could be a GP-led secondary buyout, where the funds, basically the assets are sold to a continuation vehicle with the GP continuing, but which gives exit to its existing LPs and existing investors and gets in new capital. So we have seen those sort of instances as well, even with domestic Indian funds. So in short, I think the given that we have multiple avenues of exit, I think that makes it great for the market. It gives a lot of options to private equity investors, and instead of just focusing on one or two exit avenues.
Right, lots to choose from. Good news. I think that is the key takeaway. I think we have got Ashutosh back. So Ashutosh, we will invite you straight away to the conversation. I think I was just about to ask you about how to bridge the valuation gap in the current climate, the perennial debate. So can you shed some light? How do you bridge this valuation gap debate? Is fine to know the structure, the sector. How do you structure the valuation gap?
Yeah, you're right, Prasid. It is, in fact, a perennial debate in every transaction that we do. That's something that comes up. Days and weeks are spent on trying to sort of bridge the valuation gap, and the current environment is not helping. I think the current environment is making these discussions even lengthier. I think the valuation gaps are increasing by the day. A few structures have evolved by trying and testing them over a period of time. I think the first one and the most common structure, of course, is earn-out mechanism or deferred payment, where a part of the payment is held back by the purchaser and it's paid out depending upon whether certain financial or other operational metrics are met or not. So that, of course, is the most common way of doing it. The other mechanism that we are seeing evolve over a period of time is rollover. So where the seller is required to then reinvest a part of the investments that he's got either into the target or into the acquirer that has got the target, such that if there's an upside in the future, then the seller also benefits from it. That also ensures that there's alignment of interest of the seller and the purchaser, because the seller has his money where his mouth is. He's also increasingly inclined to grow the business of the target going forward. The third thing that we're seeing is convertible instruments. So when the purchaser comes in, the purchaser, in addition to doing a secondary, may put in some money in the company as primary. And depending upon whether certain metrics are met or not met, the conversion price is then determined to the extent of investment that translates into shareholding for the purchaser. Of course, if you're a non-resident investor, then there are pricing guidelines to comply with. So there's only so much headroom that you have when it comes to conversion. So as a corollary to this structure, what we are seeing is that the promoters put in some amount of money, get a convertible instrument as resident investors into the Indian company, and depending upon whether metrics are met or not, you have a situation where the promoters get some stake in the company back again. And finally, what we are seeing is that buyers are now willing to allow the sellers to carve out non-core assets. So to the extent that they don't directly relate to the business of the company that's being acquired, the buyers are willing to say that the sellers can, as a condition to the transfer, take the assets out for themselves. That allows the sellers to monetize the assets themselves, grow them if they like, and that again helps bridge the valuation gap. So there really is no perfect solution for any of this, and this is an issue that will continue to crop up. But some structures have evolved over time that help sort of try and bridge this gap to the extent possible.
Very useful, Ashutosh. I think this is obviously a matter of negotiations, bit of give and take. That's step one aspect, Shishir, where there is less room for negotiation is regulatory bottlenecks. And every M&A deal which is great, a PE deal, has a not so great regulatory bottleneck. So what is the red tape? What kind of regulatory bottlenecks is plaguing today's PE investors in the deals they're doing?
So, Prasenjit, there are two surprisingly conflicting trends at play. Just as a foreign investment destination, there seems to be a lot of talk from the government about easing bottlenecks, and of course, they've done away with the FIPB. They've liberalized the FDI policy. But I think there's another parallel track of developments which tends to be in the other direction, which is sectoral regulation and just regulation of foreign exchange and tax regulation. And I think it's now becoming clear that to make foreign investment in India easy, it isn't just enough to liberalize India's foreign direct investment regime. There need to be corresponding liberalizations at individual sectoral levels. And it doesn't help if the foreign exchange regime continues to be where it was 20 years ago. Just liberalizing individual sectors doesn't help. So to answer your question, I think certainly pricing continues to be a huge challenge, especially in public M&A, where it's becoming almost regular for stock prices to move for reasons that have nothing to do with the underlying quality of the asset, and yet transactions that are negotiated at arm's length between unconnected persons are not consummated because the tax department and RBI force you or disincentivize transactions at a different price. I think this is becoming a very, very recurrent topic. And then depending on the sector in which you invest, I think there's just fair amount of complexity about around the operations. This is obviously not relevant for businesses like e-commerce or technology-driven businesses, but in a lot of other infrastructure tends to be highly regulated. Financial institutions, whether it's insurance or any other form of financial intermediation, asset management, all these businesses are so highly regulated that again, foreign investment there tends to struggle a fair bit.
Right. That's very insightful. And I think, of course, these are tough issues, but not insurmountable. That's why you have experts like Shishir and others to navigate you in case you need advice. Ashutosh, bringing you in straight away, I think another very hot topic, warranties, indemnities, but they are so hotly debated, it actually poses the risk of derailing a deal. So, what's the current trend in terms of negotiation approach to negotiating escrows, warranties, indemnities? If you can throw some light.
Yeah, sure. Again, Prasad, another topic that we spend days and weeks negotiating on transactions. I think as far as warranties go, I think the package largely remains the same. I think any investor cutting a large check would want protection. So the suite of warranties that are sought would more or less remain the same, some give or take here and there. But I think what's really changing is what's the backstop for those warranties. who's providing those backstops, what's the extent of those backstops. So I think the first, of course, emerging trend that we're seeing, and Anshuman spoke about it at the beginning of this discussion, is this increase of warranty and indemnity insurance that we're seeing. And we're seeing warranty indemnity insurance in almost every sale where a PE is exiting. So if the PE is exiting, more often than not, you will not see them backing warranties themselves. They'll provide warranties, but if those warranties are provided, they'd expect that the purchaser take cover from a warranty indemnity insurance as far as any backstop is concerned. In fact, even when the Ps are not selling, but the Ps on the buy side, if the process is competitive, if the auction is something that sees a number of buyers, we are seeing often, especially private equity investors, preferring indemnity insurance that sweetens the deal, that gives the promoters a clean exit, or at least gives them the ability to walk away from the transaction with as minimal representations, warranties, and backstops as possible. So these are the two things that we're definitely seeing that are changing. And the third thing that we're seeing change quite significantly, Prasajit, is what I'd call rationalization of indemnity limits. I think till a few years ago, you would have purchasers coming in and saying that they want 100% backstop for purchase consideration, that fundamental warranties would be forever, business warranties for 3 to 5 years. I think many of the investors who've invested in India and have spent nights and nights negotiating indemnities have now realized that perhaps those indemnities don't get called into that often. And what you're seeing is that there is some amount of sort of risk allocation happening where buyers come in and they're willing to look at what I call reasonable limitations to indemnity. So be it monetary caps, the extent of time for which these indemnities will be alive, and also what's categorized as a specific indemnity. So if it's not something that's significantly going to derail the operation of the company, let's say non-stamping, not having a particular non-core license, I think parties are willing to live with that without seeking indemnity protection. So that's what I see. I think trying to sort of reduce the gap of risk allocation, one by getting indemnity insurance, and the other is trying to limit the liabilities by bringing in reasonable caps.
Right. Very, very useful response indeed, Ashutosh. Maybe one last question, and I see a flurry of audience questions, so we will definitely pick them up. But one last question before we head towards that segment. Maybe Anshuman and Ashutosh, both of you can have a stab at it because Anshuman, you talked about exits before. So, in terms of what challenges are you foreseeing in for P folks to have an exit in controlled companies? Any specific nuance you wish to highlight?
So,
Yeah, maybe sorry, Anshuman, go ahead.
right. So, Ashutosh, why don't you continue and I'll pitch in.
Yeah, sure. So, Prasid, I think one, of course, getting an exit for Ps is easier if it's a controlled acquisition that they've had as opposed to minority, because to that extent, their reliance on other factors is lesser. But again, getting exits from controlled companies is easier said than done. In the first, of course, hurdle that they face is the regulatory restrictions on pricing guidelines, where non-residents can't be guaranteed an assured exit. So, to the extent, even if there are put or call options in the agreement that allow for an exit at a fixed value, they're not necessarily enforceable every time. So, I think that's the first sort of regulatory restriction or hurdle that Ps face. The other bit about control is that even if the Ps are in control, many a times there's still reliance on key management, on existing promoters, be it for continuing relations, for transition support, for just running the process that gives the incoming purchaser the necessary information. I think in PE controlled companies also that reliance continues, and if the promoters don't necessarily cooperate, that can derail the entire process. Uh, the third thing about getting a clean exit from controlled companies goes back to the discussion that we were having about warranties and indemnities and the backstops around it. A clean exit would obviously mean that there is no tail liability for the investor that's selling. The problem with that is that if you're a minority, the purchaser may not require the PE to provide warranties and indemnities. But for a control deal where the PE is in control of the company, there will be an expectation of warranty and indemnity. Now, the indemnity to some extent gets captured and covered by insurance, but there are certain matters that get left out of the package. So let's say if it's a known warranty, a known risk, known litigation, in that case, there is still some requirement on the part of the purchaser where the seller backstops the indemnity, and then a clean exit becomes a difficult for the PE to achieve.
I think Ashutosh have largely covered all the key points. I think one additional point, maybe it's not to do with clean exit, but we spend a lot of time, especially as a PE selling a controlling stake, negotiating CPs, because Ps want deal certainty when they sign the document, and when they sign a definitive document, we would all like to assume from the sell side that the deal is as good as done. So negotiating lockbox and leakages, narrowing the definition of material adverse event. So these are the things that we spend a lot of time negotiating. Totally depends on the sector as well and how much time elapses between signing and closing. Another key point where we see a lot of debate and discussion is the role of the continuing KMPs. And the buyers often try to negotiate that not a single KMP should have resigned as a CP to the deal, and we say that okay, that is completely up to the buyer, and buyer needs to find ways to incentivize those KMPs to continue. So having good management incentive plans with liquidity events pre-codified does help the private equity seller incentivize those management employees to also continue with the new buyer. So I think these are the key points which become quite critical when uh, we are negotiating an exit by a private equity.
Excellent. That's a very wholesome response to that question. Uh, so I think we still have 30 minutes on the clock so that our audience can manage their time well. I will spend next 15 to 20 minutes on audience Q&A with a brief takeaway from each of the speakers and then the poll and the concluding remarks. Uh, so first question, maybe Shishir, you can take because you alluded to the diligence aspects and all in one of your responses. So this is a question from Mr. P. Dhanunjay. Uh, he asks what implications ESG factors has in M&A transactions, whether separate ESG due diligence is contemplated often in current M&A deals. If you can throw some light.
That's actually a great question. And there's a way to divide transactions by sectors in a lot of. So, firstly, within the ESG, I think environmental diligence tends to take an oversized importance, while all the other parts, whether it's labor practices, social impact, governance, all these issues are relevant. But I must say, as a separate area of ESG diligence, environmental diligence tends to take up the most amount of space. And it's in the very nature of that that this happens in very specific sectors: industrials, waste management. Even within industrials, there will be businesses which tend to be high impact with more touch points on the environment. Of course, in those sectors, ESG tends to be a very important area of focus. A lot of our attorneys spend a lot of time finding allocation of risks on specific ESG constraints that have been identified. So yeah, I can certainly confirm that these issues tend to be very relevant in specific sectors.
Hope that answers the question satisfactorily, Mr. Dhananjay. The next question, maybe Ashutosh, I can request you. The question is, what are the most commonly negotiated deal breaker clauses in current PE deals?
Yeah, I think Anshuman spoke about some of them. I think you can divide again these broadly in two buckets. One what we call pre-closing buckets. So the pre-closing bucket will be where there'll be clauses for deal certainty, and there'll be clauses that allow for risk allocation. So in deal certainty, you have clauses like what would be the CPs between signing and closing? Is there anything that can upset the deal? the material adverse events that can result into the deal being terminated. So that bucket gets very hotly debated because once the deal's signed, the seller wants to ensure that there is really no roadblock between signing and closing. That's the first deal breaker. And the second deal breaker is around risk allocation. Again, we spoke about some of them, about what's the purchase price adjustment between signing and closing. Uh, is there any earn-out mechanism? Should there be any valuation gap that needs to be bridged? And again, the risk allocation again brings us back to the entire discussion on warranties and indemnities. What's the extent of warranties? Who's backstopping them? So as far as pre-closing clauses go, I think these are the ones that are debated the most often and then result in deal breakers at time. And as far as clauses that are post-closing, to the extent that it's not a complete buyout, to the extent that both the seller and the purchaser continue to remain in the company, some common deal breakers are the control rights that the investor seeks. So if it's reserved matters or other operational control that the investor wants, that gets hotly debated. Uh, if the promoter is somebody who's continuing in the business, has other business avenues, then non-compete is another aspect that gets debated very often and can often result in transactions not going through should the promoters find the restrictions too onerous. And lastly, especially in the context of PEs, one aspect that becomes hotly debated and can often result in deals not happening is the extent of exit that's being promised to the PE. So generally, you'll have provisions which say that parties will make efforts for an IPO or a strategic sale. But what happens if there is no avenue available for that sale? Should the promoters backstop that by way of a put option, provide any other sort of mechanism whereby this can be cured? I think that's another aspect that gets hotly debated. And if parties are not really in agreement on what that end result is, it often results in joint ventures and minority interests, especially, not taking off.
Yeah, no, absolutely. Couldn't agree with you more. Very, very hotly debated and therefore called deal breaker provisions. Uh, Anshuman, if I can turn to you for this question, slightly technical in the sense that the question is in light of the recent FDI policy and competition law changes. How do you see deal making being impacted in a PE context?
So, uh, thanks, Prasenjit. There are a few positives that I must share with the audience here. So, I think one of the key concerns that has really plagued FOCCs, and the reason why I mention FOCCs, which is basically foreign owned or controlled companies, is when Ps take controlling stake or do platform, go by the platform strategy, these platforms are often acquiring, doing bolt-on M&As, acquiring assets. So there have been several gray areas, if I may call it, on whether the deferred consideration norms that apply to non-residents investing in India apply to FOCCs or not. There have been differing opinions given by various AD banks. So thankfully, all of that has now been clarified by the government, and the government has basically said that whatever applies to the non-residents will also apply to FOCCs. So that brings a much needed clarity to the rules that apply to FOCCs, which are often owned by private equity as their platform vehicles, and it gives them more flexibility to basically ensure structured deals and bolt-on acquisitions. Of course, the changes to the FDI policy are also positive. Like, for example, the Union Budget of 2025 proposes to increase the FDI limited insurance to 100%. So that's a great positive, given that this is a sector where private capital is definitely required. There are also some new age sectors where the government has decided to liberalize FDI policies, for example, manufacturing of satellites, etc. So I think these are the positives. Also, in terms of competition law, of course, there is a new third limb that we need to be wary of when we are structuring deals, which is the deal value threshold, which was introduced in the Competition Act. So traditionally, we only used to look at the asset and turnover test of a target to determine whether or not a particular deal is requires the approval of the Competition Commission of India. But now we also need to look at the deal value threshold, and there are certain additional criteria regarding significant business ownership if it's a part of a global deal. So largely these are the key changes in the FDI policy and Competition Act that we would be wary of.
Thank you, Anshuman. So it's not all gloom and doom, a lot of good news and in between some challenges. So on the right path. Shishir, if I may come to you, this is actually a very interesting question because this is again around regulated sector, and the question is broadly that when you're investing in a regulated sector, it's just not the target, but who your investors are. So how are private equity players navigating the regulatory maze given their complicated, intricate LP structures?
So this again, Prasenjit, depends on the sector in which they're investing. On automatic route sectors, the view that has emerged in the market, absent any government clarification, is that as long as LPs based out of border countries are under 10% in the aggregate, you don't need any separate approvals. I think there are specific regulators who tend to take a slightly different view. So we know, for example, in pharma investments, a lot of private equity investors have tended to use clean funds. They strip the entire investment of any um, LP money from border countries. We've also seen that in some of the sub verticals within the financial institutions ecosystem, the queries tend to get very detailed about the ultimate beneficial owners. In those instances, also, some of our clients have benefited immensely from using clean funds. But I think outside of, sorry, and then there's, of course, FATF grey list countries. That's also a significant concern in the financial institutions ecosystem. So private equity funds which have either pooling vehicles or SPVs based out of FATF grey list countries are now advised to set up alternate parallel structures. But outside of these, I don't think I think there's a fairly high degree of familiarity within Indian regulators of how private equity structures are set up. And I don't think the complexity of the pooling and LP vehicles matters that much to deal making.
That's good to hear. I think that should calm the jangling nerves, if any. I think so. That should be good. I think maybe one last question I squeeze in before we go to the key takeaways and the poll and conclusion. And maybe I go to for this to Ashutosh. Ashutosh, this is about again a hotly debated topic, geopolitics and its impact on deal making. I recall a very well-known saying and adage that if world catches kind of cold, the capital gets a flu. So are you really seeing that kind of impact that because of the all kind of cross-border geopolitical issues plaguing? How is that really impacting deal making in the PE context, if at all?
Yeah, so Prasenjit, of course, India can't go idly by if there are geopolitical tensions. But I think the first one is to the extent that there are US China issues or if there are other political instabilities, the entire discussion about diversification of supply chain, call it China plus one or others. I think that, in my mind, in a sense, has helped India a bit, where there is now some concentration of capital that's happening in India to diversify the supply chain, especially in such sectors like manufacturing. So that's something that's helped India. Also, generally, at least amongst emerging markets, India is seen as a fairly stable economy, a fairly stable political system. So I think that's also helped generally from a geopolitical situation in India in trying to garner as much sort of PE investment that we can. In fact, many PE funds are setting up Asia specific funds and now allocating specific funds only to India investment. So uh, I think the global sort of turmoil to some extent is helping countries like India that provide some sort of stability. But again, the result of the global turmoil is, in my view, that PE investors will be more cautious in making investments, and to that extent, there'll be a flight towards more quality assets as opposed to them trying to sort of dip their hands in a number of investments in these uncertain terms. So there will be assets that will demand a premium. I think India in a sense, is ahead of most other countries. But that benefit perhaps will come only to assets that are doing well, that are quality assets.
Right. I think one last question. This is specifically for Shishir, so I will have to take it specific request. So I think Shishir, this is basically in terms of reforms. If you had the magical wand to reform the Indian regulatory space to make India P magnet, what would be those three four fundamental changes you would wish to bring in?
Actually, I don't think I would have any fundamental changes. I think the changes would be fairly simple. I would remove 56(2)(10) from the Income Tax Act, or at any rate, dial it down
Mm,
significantly. And I
mm,
would liberalize pricing.
mm,
I feel the safeguards that were needed 25, 20 years ago cannot continue to be the safeguards that the country needs today.
mm.
I think we really have to go away from a mindset of capital deficient, a capital deficit country. I really think arm's length transactions between unrelated parties, no arm of the government, whether it's a central bank or the executive, should be getting involved in pricing.
Yeah, not true. Absolutely well said. In fact, I keep on saying last question. There's one more question from Meghna Inandar on a connected point, Shishir. That is there any chatter on easing of Press Note 3 implementation? This goes to the connected question that how do you ease the Press Note 3 implementation?
The only chatter I find is on webinars. I've not heard any, I've not heard any chatter about liberalizing Press Note 3 from the areas that matter.
Right. So again, not a ringing endorsement, a positive statement, Meghna, but what we can tell you is that as a firm, we have handled obviously many of these approvals, and it takes time, but eventually with a proper follow up and a well drafted application, you can actually get success in getting these approvals expeditiously. So that's on that. So again, just respecting time, I think we have 15 more minutes. So I will now request each of our expert panelists to maybe share two key takeaways from whatever aspects they covered, so that the key points which the audience can take away with them, absolute must, 2 points each. Maybe Anshuman, Shishir, and Ashutosh in that order. Yeah.
Sure. Thanks, Prasenjit. I think uh, two key takeaways which I would stress on is one is platform deals and control PE deals are here to stay. We will see more value creation, asset creation by private equity using these two routes. We will see more instances of industry experts being acqui-hired by private equity firms to basically drive their platform strategy. Uh, Another key takeaway for me, and which is also a corollary to what we have seen, is we are seeing quite a bit of MNC carve-outs where MNC are cashing out on the India story by selling off or hiving off assets. That creates more opportunities for quality private equity with large amounts of dry powder to basically come in and own these businesses and basically create more value going forward. So that's another key takeaway from me.
Yeah,
I,
I think two. Sorry, Shish, go ahead.
I would say I think private equity investors have gone through more than two or three cycles in India now. I think so. The degree of deal sophistication and just familiarity with the Indian ecosystem, the Indian industries, the Indian government is just very, very deep, and that eases deal making considerably. I think their ability to be flexible terms and structures and their appetite for risks has we've those of us who've been in this space for the past 20, 15 years, we can see that evolution. And I think that converges with just the time when the Indian economy is, of course, taking off, and so are the capital markets. So I feel that that convergence of all the all the good tailwinds have it's a very positive place to be in if you're an investor or a company looking to raise funds.
So, and just to add to what Anshuman and Shashish said about uh, control and efficiency, I think the consequence of that is that deal sizes are going to get larger. I think as we move ahead, Ps and other investors are going to cut larger checks. So that's really the first thing that will happen on investment. And that means that when an exit comes, the deal is going to be even larger. The size is even bigger. So I think Ps will have to plan their exits much ahead in time, perhaps use a combination of public markets, private sales, and even continuing funds that Anshuman spoke of.
Excellent. Thank you very much all for those sharp and thought-provoking insights. I think let's go to the poll slide, Prajay. If I may request my IT colleague to pull up the poll slide. I think before closing, I would request each of the audience members to respond to the poll slide on your screen to provide your feedback on today's webinar. We take this very, very seriously as part of our continuous improvement program. Thank you very much to everyone who participated in this poll. Finally, I would like to thank all our presenters on your screen for sharing their expertise and experience with us today. Uh, it was absolutely outstanding to hear them. Thank you so very much. You didn't just share insights; you made complex deal terms sound almost, less controversial. We're very grateful for your time, clarity, and candor. Also, thanks to our audience members for your time and attention. We hope this session left you with more answers than questions, and perhaps even a few ideas for your next deal. We certainly enjoyed putting this together for you. After the webinar, we will send you the copy of today's recording, presentation materials, and a link to the webinar recording. You will also separately receive a feedback form for this webinar. Please feel free to send your feedback, comments, criticism, compliments. Everything is most welcome. The form will take barely less than a minute to fill up. And if today's session sparked interest for in-house training or deeper conversation, feel free to reach out. Our contact information is on the screen before you. Thanks once again, and we look forward to seeing you at the next edition of M&A Masters. Until then, take care and may your valuations be fair and your exit terms clean. Thank you very much.
Thank you.
Thank you.